All right, hello everyone, and welcome back. And in today's lecture, we're going to go through a few exercises where we actually run through scenarios and identify different accounts in those scenarios. This is really the first thing that we're going to do before we start journalizing accounting transactions. And these are some common scenarios that are probably going to come up throughout your accounting course. So, as a quick recap, in the first two lectures, we covered off on the accounting equation, and we also talked about some of the common accounts that show up under these three different categories. We talked about different asset accounts, different liability accounts, and different equity accounts. Now, before we go on today's lecture, it's very important for you to understand the accounting equation and the different accounts that go under each of these categories. So if you haven't visited those first two lectures first, I'd highly recommend that you start there. But without further ado, let's go into a few examples. So in example scenario 1, we've got on January 1st, Sherry Williams forms Acme Corp. Sherry personally invests $30,000 in the new company and deposits the cash in a bank account under Acme Corp. And the first thing I want to start out with is by saying that every time you go through one of these scenarios, you want to think about it from the perspective of the business, not necessarily the owner. So in this example, the business is receiving $30,000 while the owner, Sherry, is really losing or giving away $30,000. But just keep that in the back of your mind. We're always thinking about these scenarios from the perspective of the business. Now, when we go through these scenarios, there's really three things that we want to do. First, we want to identify the impacted accounts. Secondly, we want to categorize those accounts. Is this an asset account? Is it a liability account? Or is it an equity account? And the last thing that we want to do, at least in today's lecture, is state whether the account is going up or going down. So keep that in mind as we go through a couple scenarios together. So let's break down this example. So Sherry invested $30,000 in the business. I can pause right there because I know that cash is one of the impacted accounts. So we're going to circle it here. And the next thing we need to know is what type of account is cash. Now, going back to those prior lectures, we learned that cash is an asset account. And the last thing that we want to break down is this account, is cash going up or down from the perspective of the business? In this case, cash, the asset, is going up. So we know that our assets are going up. The next thing we need to do is identify what's the other account that's being impacted in this example. And in this case, we've got our owner, Sherry, who's investing money into the business, which is going to drive or increase the equity of the company. So we've got our equity account, which is our owner's capital account, going up by $30,000. And the last thing that we want to do is pull up our accounting equation and make sure that it still balances after this transaction. So in this case, cash went up $30,000. That was the only impact to our assets. Our liabilities weren't impacted in any way, and our equity went up $30,000. And this is a good transaction because our accounting equation balances at the end of it. So let's go on to a different scenario. Now, in this case, we've got Acme Corp about a week later using $500 of its cash to purchase supplies. So again, the first thing that I want to do is identify what accounts were impacted. And I recognize first that cash was impacted. Our company used $500 of their cash to purchase supplies. So you want to ask yourself, A, what type of account is cash? In this case, it's going to be an asset account. And then you want to ask yourself, well, what happened to the asset account? Did cash go up or down? Since we were spending our cash, cash went down by $500. Now we're going to identify what's the other impacted account. In this case, it's supplies. So the next step is to figure out, okay, what type of account is supplies? And if we go back to our prior lectures, we would know that supplies is also an asset account. In this case, supplies went up. We basically exchanged our cash for supplies, so the supplies themselves went up. Now, if we go on to our accounting equation, this is going to be a little bit unique. We're only going to stay on the asset side of the accounting equation because our liabilities or our equity weren't impacted. Since we acquired $500 of new supplies, our assets went up $500, but at the same time, we used our money to purchase those supplies, so our cash went down $500. What's important, though, is that the accounting transaction, the accounting equation, still balances here. And in our last scenario, we have a similar example, but let's pretend that instead of buying the supplies with our cash, we bought supplies on account. And this basically means that we're receiving the supplies today, but we're going to pay for them later off into the future. So let's go through that scenario with this in mind. So the first thing we do is identify which accounts were impacted. The easy one here is supplies. I know that I've acquired $500 of supplies, and that supplies are an asset account. So my supplies are going up $500. So far, very similar to the last example. What's different, though, is that we're not giving away our cash quite yet. Rather, we owe our vendor money in the future. So if you recall from our second lecture, whenever we owe something into the future, this is going to be a liability, commonly known as an account payable. So we know that our assets went up with the supplies going up, but we also know that our liabilities went up because we now owe money in the future. So lastly, let's pull up our accounting equation. In this case, supplies went up $500, but our liabilities also went up $500. The accounting equation balances, so we're good to go. So thanks for joining today. For some more examples and more information, feel free to visit us at easyaccounting.com. Thank you.